Welcome to this video on the zero debt advantage and how to turn early success into true financial freedom. Today, we will reframe your rare position, no student loans, a paid-off car, and a scheduled $60,000 disbursement, into an acceleration plan rather than a stability plan. First, we will lay out the roadmap. Next, we will set expectations with a brief disclaimer. Then, we will move into concrete actions you can take before your full-time job begins. After that, we will harness your windfall and implement an aggressive savings plan once your job starts. Finally, we will reinforce the strategy with key takeaways, a couple of quizzes, and a practical summary. Here is today's agenda. First, we'll explain why being debt-free at the starting line is a superpower. Next, we'll detail pre-funding steps before your start date. Then, we'll maximize tax-advantaged accounts. After that, we'll convert your scheduled $60,000 disbursements into a systematic investment engine. Subsequently, we'll frame the 50% or more savings rate and how it accelerates financial independence. Additionally, we'll tackle lifestyle creep. Finally, we'll test your understanding with short quizzes and end with a concise summary and call to action. Before we proceed, a quick but important disclaimer. This video is for educational purposes only and does not constitute financial, tax, or legal advice. Investing involves risk, including the potential loss of principal. Verify current IRS contribution limits and plan details, which may change over time. Consider consulting a qualified professional who understands your personal circumstances. With that in place, let's transition to your unique starting advantage. Your situation is rare. You're starting with zero debt, a paid-off car, and a scheduled windfall. That means the typical playbook of slowly building stability under the weight of payments does not apply. Instead, your cash flow can be redirected into investments from day one. The $60,000 disbursement, paid in $500 installments, can be converted into a disciplined investing stream. Your starting salary, combined with low fixed costs, effectively amplifies your savings power relative to peers carrying debt. Therefore, the mission is to pre-fund your safety net, invest systematically and aggressively, and keep lifestyle creep in check. Next, let's visualize the path from here to financial independence. This flowchart shows the progression from your zero debt starting point to financial independence. First, you pre-fund your plan by establishing a 6-month emergency fund. Next, you prioritize tax-advantaged accounts like a Roth IRA and begin contributing early in the year. Then, as each $500 installment hits, you dollar-cost average into low-cost index funds rather than letting cash sit idle. After you start your job, you push a 50% or greater savings and investment rate. You then maximize 401k and HSA contributions and place any overflow into a taxable brokerage account. For allocation, you lean heavily into equities early using broadly diversified, low-cost index funds. Finally, you automate, rebalance periodically, and guard against lifestyle creep as you move toward financial independence. Now let's walk through the immediate pre-funding steps. Start with infrastructure. Open a high-yield savings account for your emergency fund and a low-cost brokerage account that supports automatic investing. Next, automate transfers so that your emergency fund grows predictably, targeting 6 months of essential expenses before your start date. Then, fund your Roth IRA as early in the calendar year as possible, subject to earned income and eligibility rules, because time in the market can improve compound growth. Finally, configure an automatic investment rule so that each $500 installment is invested on arrival without manual intervention. With this foundation in place, we can now maximize tax advantages. Your Roth IRA is a powerful tax advantage vehicle. Aim to reach the annual limit as early as practical each year. But remember that Roth contributions require earned income and are subject to eligibility and income thresholds. The scheduled $60,000 disbursement will typically not count as earned income and therefore cannot be directly contributed to the Roth IRA. It belongs in a taxable brokerage account. By funding early, you increase time in the market rather than waiting for a future pay raise to start. When your job begins, if your employer offers a 401k match, prioritize capturing the entire match because it functions as an immediate return on contributions. Next, let's build your financial fortress. The emergency fund. Your emergency fund is the safety layer that prevents forced selling during downturns or life surprises. Calculate it based on essential expenses only, not discretionary spending, and set a target of 6 months. Park the money in a high-yield savings account. Automate weekly or bi-weekly transfers so progress is consistent. Keep the emergency fund separate from your investment accounts to reduce the temptation to dip into it. With your fortress established, we can address how to invest each windfall installment. Each $2,500 payment should be considered investment capital, not discretionary spending. Set up an automated dollar-cost averaging rule to purchase low-cost, diversified index funds, commonly a combination of total U.S. and total international stock funds. Avoid trying to time the market. Invest the moment the cash appears to reduce analysis paralysis and opportunity cost. Keep records of each purchase for later reviews and to facilitate periodic rebalancing. Having automated the windfall investing, we can now compare savings rate strategies. Comparing a 50% or greater savings rate with a conventional 15% rate highlights vastly different trajectories. With a high savings rate, compounding accelerates, and your financial independence target shrinks because your lifestyle spending remains lean. This creates resilience against job or market shocks and opens options such as sabbaticals or entrepreneurial ventures much earlier. In contrast, saving 15% slows compounding, raises your financial independence target due to higher spending, and leaves less room to maneuver during downturns. Now let's ground this with an illustrative table of time to financial independence under common assumptions. This table provides an approximation of years to financial independence for various savings rates, assuming long-run real returns around 7% and a 4% withdrawal guideline. The exact numbers will vary based on returns, taxes, and lifestyle. The point is directional. Higher savings rates dramatically compress the timeline. Next, we will turn to practical tactics for fighting lifestyle creep so these numbers become achievable. Lifestyle creep is the silent killer of early acceleration. Pre-commit by automating more than half your pay into investments on payday so spending adjusts to what is left. Keep fixed costs low through housing strategies, bill negotiations, and resisting vehicle upgrades. Include a modest fund budget so you can spend guilt-free within a controlled boundary and avoid backlash spending. Delay non-essential purchases with a 30-day rule to filter impulse buys. Finally, review your budget and contributions quarterly to make iterative improvements. With spending controlled, let's prioritize tax-advantaged accounts in a clear order. A clear prioritization helps you act decisively. First, capture the full employer match in your 401k because it is free money. Second, fund an HSA if you have an eligible high-deductible health plan. Consider investing the HSA and paying current medical expenses from cash when feasible. Third, maximize an IRA based on your eligibility and tax situation, choosing between Roth for tax-free growth or traditional for an upfront deduction. Fourth, invest any remaining funds in a taxable brokerage using low-cost index funds. Finally, automate contributions and reassess annually as IRS limits and your income change. Now let's discuss risk and asset allocation at your stage. Given your long time horizon, a portfolio with a high equity allocation can be appropriate, such as a 90-10 or 80-20 mix of stocks to bonds. Diversify broadly with total U.S. and total international stock funds. Add bonds or short-term treasuries to stabilize the ride as needed. Rebalance either on a set schedule or using threshold bands to maintain your target mix. Keep expense ratios low to preserve compounding over decades. Consider asset location by placing tax-efficient equity index funds in taxable accounts and holding bonds in tax-advantaged accounts when possible. Up next, a quick knowledge check. Question: what is the best use of each $2,500 installment to build foundational wealth quickly? Option A: automatically dollar-cost average into low-cost, diversified index funds upon arrival. Option B: hold in a savings account until markets feel safer. Option C: wait to invest until the total $60,000 is received as a lump sum. Option D: spend on lifestyle upgrades since there is no debt. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to automatically dollar-cost average into low-cost, diversified index funds as each installment arrives. This reduces timing risk, keeps cash active in the market, and enforces disciplined behavior. Next, let's verify your emergency fund prioritization. Question: before your new job starts, which step is the top priority to pre-fund your plan? Option A: build a 6-month emergency fund in a high-yield savings account. Option B: buy a newer car to treat yourself. Option C: speculate in cryptocurrencies with the windfall. Option D: Wait for the higher paycheck before doing anything. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to build a 6-month emergency fund in a high-yield savings account. This creates a buffer that prevents forced selling or derailed investing due to unforeseen expenses. With the essentials locked in, let's capture a few key takeaways. Here is a concise 12-month plan using a quarterly cadence. During months 1 through 3, establish accounts, automate the emergency fund, and set auto-invest rules for each $2,500 installment. In months 4 through 6, capture any employer match once the job begins, fund an HSA if eligible, and continue progressing toward the Roth IRA annual limit given eligibility. In months 7 through 12, raise your savings rate to above 50% by paying yourself first. Rebalance if your asset allocation drifts beyond set bands, and review your fees, contribution limits, and lifestyle creep each quarter. As we wrap up, let's highlight the essential points. These are the core takeaways. Treat your zero-debt start as an acceleration opportunity. Build the emergency fund first. Then invest each $2,500 installment automatically. Maximize tax-advantaged accounts and send overflow to a brokerage. Aim for a savings rate above 50% to compress the years to financial independence. Automate, diversify using low-cost funds, and rebalance periodically. Now, let's summarize and close. In summary, you will pre-fund safety with a 6-month emergency buffer, then invest on schedule without waiting for ideal conditions. You will leverage Roth IRAs, 401ks, and HSAs according to current rules and your eligibility, and you will verify annually as limits change. Each $2,500 installment will be dollar-cost averaged into low-cost, diversified index funds. Early on, you will maintain a high equity allocation, rebalance as needed, and conduct periodic reviews. You will guard against lifestyle creep and automate a savings and investment rate above 50%. Finally, here is your closing invitation. Thank you for watching. If this plan helped you, please like the video, share it with someone who needs a head start, and subscribe for more content focused on building wealth in your 20s. Tell us in the comments which step you are committing to this week and what obstacles you want help overcoming next.